Today, we will find out if all those record profits make Loblaws a good fit for your portfolio. Holy banana bread, let's do this. Loblaws, as well as the other two big grocery chains in Canada, have been in the news lately. It seems they are all making some pretty nice profits while customers are struggling to feed their families, thanks to that out-of-control inflation on food. In fact, the House of Commons is looking into it, all to make sure the grocery chains are not unfairly choosing profits over customers' needs. That, of course, is a story for the live stream, Sundays at 4 p.m. Eastern. Before we clean up the spill on aisle 12, let me know in the comments if you hold any grocery-related investments. I do currently hold Slate Grocery REIT. As always, I am very grateful to see you all here in the home of free financial content on YouTube. If you are new, please subscribe right now so you won't miss a single moment, and a huge thank you for that click. Loblaws Companies Limited is one of the biggest retail grocery chains in Canada, with stores, well, from coast to coast. They have regional divisions which include West Fair Foods in the West, National Grocers Co. in Ontario, Provigo Inc. in Quebec, and Atlantic Wholesalers in Atlantic Canada. They also own No Names Brands, President's Choice, and Joe Fresh. Initially, they began all the way back in 1919 in Toronto as a single store, and presently they now employ over 136,000 full-time employees. From groceries, pharmaceuticals, cosmetics, and alcohol to financial services, cellular phones, and baby products, the Loblaws family of stores include Loblaws, Extra Foods, Fortino's, Fresh Mart, No Frills, President's Choice Financial, Provigo, Real Canadian Superstore, Shoppers Drug Mart, Pharmaprix, Super Value, TNT Supermarket, Value Mart, and Zephyr's Market. Holy banana bread, that is a mouthful for sure. Of course, size isn't always everything. We need to check out those numbers. As for the usual, we will begin with the surface data. They have a market cap of $36.24 billion, thus making them a large cap stock. Their beta comes in at 0.03, which is definitely one of the lowest betas I can remember. Needless to say, they are not very volatile. Their earnings per share comes in at 5.92, and their diluted EPS is the same, so dilution is not a factor. As for those earnings, they grew last year by a very impressive 45.6%. However, they are forecast to fall roughly 2.5% per year for the next 3 years. That does sound bad, but when you factor in the big jump last year, it really is not that bad, and they are actually still quite a bit ahead. Their price to earnings ratio comes in at 18.10, which is a little bit higher than the average for grocery stores, which comes in at 14.90. I don't see this as being a big enough difference to put a lot of weight behind it. Loblaws is simply always growing, and that growth can easily help up that PE ratio. They have a price to book ratio of 3.30, so that means they are trading 3.3 times over their book value. Once again, with a growing company the size of Loblaws, that is not an unexpected number at all. Loblaws at the time of recording has a share price of $110.98. But is that their fair price? According to the folks over at simplywall.st, their discounted cash flow model predicts a fair price of $235.67, which would make them 52.9% undervalued. Being on the conservative side, I do think this is a little high, but still it's not unreasonable. I will say they do have a long way to go before they could realize that price. But then again, if they can maintain some of the current momentum, you never know how far these guys can go. Moving to returns, Loblaws does have a dividend. They have a dividend yield of 1.46% that is paid out quarterly in the amount of 40.5 cents per share. Their payout ratio on that dividend is 23.34%, making it a very stable and well covered by their earnings dividend. Those are the dividends I like. With growth, they entered 2021 with a share price of $63.01 and grew to $105.15 by year's end. That translated into a return of investment of 66.88%. Adding in the dividend, we do have a total return of 68.34%. Holy friggin' banana bread, that's not too shabby at all. So far this year, they have risen further to 111.36, which is an ROI of 5.91%, which is great compared to the S&P 500's negative 16.76% performance so far this year. I do love their growth, but of course, we still have to look at their debt. As of June 2022, their total debt amounted to $7.828 billion, and their equity amounted to $11.338 billion. This means that their debt to equity ratio is 69.0%, which is quite manageable. I also like to consider their debt to equity ratio was 119.7% just 4 years ago, though that was more of an aberration, as before that, it usually was hanging around 80%. This is a strong indication that they have been managing their debt well. Despite that, I still want to dig a little bit deeper. If we look at their short term, their assets come in at $12.23 billion compared to $9.07 billion in liabilities. That is okay. Their long-term assets amount to $24.48 billion, and that will cover their long-term liabilities of $16.30 billion. That is also good. However, the only concern here, and it's a minor concern, is that their short-term assets of $12.23 billion do not cover their long-term liabilities of $16.30 billion. I generally feel much better when the short term does cover the long. There is a lot of good with this debt. Their debt has been decreasing. Their interest payments on the debt are more than well covered by their earnings. This is a debt the company can manage well, and they have been managing it well. So, debt aside, what is the overall verdict on Loblaws? As an investment, this is a company that does make sense for growth and total return investors. They are blue chip and well entrenched in the Canadian retail market. There is as close to no danger as we can get with this one. I cannot say they will experience growth in the future like they did in 2021, but there will always be a demand for their products, even in a recession, and that will translate into some half-decent growth over time. Loblaws, my friends, is a recession-proof stock. The only negative is their short-term assets not being able to cover their long-term liabilities. But in this case, I said it was minor, and yeah, their continued earnings and the demand for their service make that a pretty moot point. I like these fundamentals a whole lot, and I will have to look at adding them to my portfolio. In a way, I'm kind of surprised I haven't already added them to my portfolio. Real Canadian Superstore, Shoppers Drug Mart, Pharmaprix. Wow, that sounds dirty. Super value. The fun does not have to end here, because you can always watch my video on dividend capture strategy that I have linked on the left, or you can check out the video on the right that YouTube thinks you will like. Your click will decide who is right, and I will see you in the next video.